Let's take a look at President-elect Donald Trump. He is set to take office in January, and Tesla CEO Elon Musk's role in the Trump administration, plus expectations of lighter regulation, well, that has put Trump's relationship with tech in focus. I got the chance to speak with IBM CEO Arvind Krishna about this at our Invest conference earlier this week. Here's what he had to say.
I think that we are all hopeful that there is going to be a lot more innovation and there is going to be less regulation. Those are both good for business across the board. I always acknowledge we need some guardrails. I always think, at least in the United States, with our system of separation between the judiciary and the legislature, there'll be some guardrails. But I'd say the business community overall, and us especially, are excited that we think there will be tailwinds to the economy going into 25.
Joining us now, we want to bring in William Kerwin. He's Morningstar's technology analyst. And William, I want to start there. Just talk about the implications of the second Trump administration, what exactly that means for big tech. Is it going to be different, do you think, second time around?
Well, a lot remains to be seen, obviously, but the word that comes to mind is tariffs and how those might impact companies. So when we think about a company like Apple, which is the largest tech name under my coverage, they were able to get away pretty much unscathed in the last Trump administration without a large tariff impact. It remains to be seen if that'll happen again this time, or if it may be different if we see a blanket tariff that could have a larger impact on Apple. So for that company specifically, we expect them to continue diversifying the supply chain outside of China into places like India and elsewhere in Southeast Asia. And we think that'll be a trend really across the sector, trying to avoid that manufacturing concentration, specifically in China.
One part of it is the manufacturing concentration. One part of it is also just the U.S.-based companies that have the most exposure to China, either through their revenues or through how they're trying to position the next leg of growth. How are you evaluating that?
Certainly. So, one sector that comes to mind here is chip equipment. So these are U.S. names like Applied Materials, which actually reports tonight, Lam Research, KLA, that reported a couple weeks back. These companies have as much as 30% of their revenues out of China. So it's a question we get from investors a lot. But when you actually unpack that number, a lot of that sales exposure into China is what we call lagging edge equipment. So not cutting edge, not producing AI-related chips, really producing more basic chips for autos, for industrial applications. So, even though there's that high exposure, we don't necessarily see it more at risk from national security restrictions and trade tensions. So you really have to unpack what's in that exposure. And sometimes even that high exposure, we don't think equates to necessarily a high risk.
William, one of the things that Arvind Krishna told me was just in terms of this expectation of lighter regulation. And I bring that up just through the lens of antitrust regulations and ultimately what that could mean for big tech down the road. Do you see more opportunity or an expectation of an uptick here in M&A deals, given the fact that we are seeing a changing of the guards in the White House?
I think it could go both ways, quite frankly. Something that stood out to me is actually, Vice President-elect J.D. Vance's comments complimenting current FTC Chair Lina Khan about her approach to antitrust regulation for big tech, like against Google, like against Meta. Now, we think the focus on quote unquote big tech will really be focused on platforms. So again, Google, Meta, and their use cases. We don't think it'll focus on a product or a company, like Apple, which really is concentrated in products rather than platforms. So we think there could still be some antitrust against the largest of tech companies. But to your point, we think M&A deals at the rung just below those largest of large tech companies can start to pick up again over the next 4 years.
Do you think that means potential breakups of some of the larger platform technology companies?
I think I'd be hard pressed to see a complete breakup, but I mentioned Google, and the example here is there's an ongoing case from the DOJ about Google's exclusive payments to Apple to be the default search provider there. We think that can result in Google no longer being able to have that exclusive agreement and opening that up. So, that's an example. It's not a complete breakup of the company, but there are measures that can be in between there that still erode at the moat a little bit, but don't result in a complete breakup.
William, as you talk about who is best advantaged at this juncture, not only given the change that we are going to see in the White House, but also just some of those broader macro trends that we, of course, have been closely following, who do you think is best positioned here in terms of an investment opportunity heading into 2025?
Well, really, the trend still, when I think about the technology sector, is AI. And the truth is that most of the firms that we see being well exposed AI beneficiaries are overvalued today. But that doesn't mean there aren't opportunities here and there in the sector. So, a couple names that I really like are one, Lam Research, one of those chip equipment companies that I mentioned earlier. We think the chip equipment group has sold off a little bit over worries of cyclicality, worries of AI reaching maturity that we think are unfounded. So we see some value there. And then even outside of AI, a company like onsemi, I think a name that I've spoken about on this show in the past, not really well AI exposed, but exposed to trends towards electric vehicles, industrial electrification, and we see that as undervalued too today.
William Kerwin, who is the Morningstar technology analyst, joining us here this morning. Thanks so much for hopping on Yahoo Finance with us. Appreciate it.
Thank you.